Once you have the business idea about what products or services you want to sell, the first thing is to test out your assumption and validate whether your product and services actually meets the market need. You want to make sure that you are spending your time and resource wisely in building what actually works in the real market. So you may want to validate your product and services as soon as possible because there will be higher loss and cost implication if you identify incorrect assumptions or flaws in your product and services at later stages. So in early stages, once you have discovered the idea that you want to build on, you want to quickly roll out minimum viable product by gathering the feedback from the potential customers in your target market. So once your minimum viable product is out in the market, you may want to gather feedback as much as possible from the early adopters of your products and services and keep making improvements and rolling out the next versions. You may want to iterate this process couple of times to get the best product market fit. By gathering the initial customer feedback and response to initial versions of your product and services, you will be able to gauge the market demand, and accordingly you can decide whether you want to keep moving forward with your products and services or want to drop the idea. Product market fit basically demonstrate that there is a demand in the market for the product and services that you are offering, and people are actually getting value from it and they are willing to pay for it. Product market fit basically demonstrate that there is a demand in the market for the product and services that you are offering, and people are actually getting value from it and they are willing to pay for it. You may find your product market fit before going for the fundraise because it indicates the profitability and scalability that your business can reach, as it shows that what problem you are actually solving and whether there is a market for it or not. Product market fit indicates company's ability to scale and grow, as it is an amalgamation of different things which indicates company's long-term success and sustainability. It is indicated by a good distribution, that company's ability to reach its potential customers in the target market, customer retention and the customer order repeat rate, and also good unit economics. Unit economics involves dealing with numbers to analyze companies' cost and revenue on basis of per unit of item sold. Now, since this cost and revenue are involved with the per unit of item sold, it can be used to calculate or project gross profit when the business scales. Having positive unit economics is very essential to measure the business success and predict the company's financial stability. Unit economics basically compares the customer's lifetime value to the cost of acquiring the customer. Now, customer acquisition cost, which is CAC, is the amount of money spent on sales and marketing to acquire one customer, while lifetime value is the average amount of money that company earns from per customer during the entire lifetime of relationship. Now, for example, if you talk about subscription business, for a given period of time, churn rate will be the percentage of customer who cancel their subscription during this period, while retention rate will be opposite to the churn, in which like customer that remains subscribed during the period is the retention rate. Now, in this particular case, the average customer lifetime value will be calculated based on the customer that stay subscribed before they churn out. Unit economics metric can be calculated by subtracting the customer acquisition cost from the lifetime value. When lifetime value per customer is greater than the customer acquisition cost, that is the sign of good or positive unit economics. Now, knowing lifetime value per customer and customer acquisition cost is also important because it helps make the projection in future for the break-even point. Break-even point is the point at which the total cost and total revenue are equal, which means no loss or no gain. So total profit at break-even point is 0. It is only after the break-even point when companies start making real profit. Now, lower break-even point indicates that the business is better in terms of financial stability and profitability. That means company will reach profitability in shorter time. You can have various metrics to measure product market fit. One of such metric is Net Promoter Score, NPS. NPS score can vary from -100 to 100. To calculate this score, you ask your customers to rate your product between 0 to 10. The customers who rated your product between 9 and 10, they are the promoters of your product. Basically, they will give the positive word of mouth and help your product go viral. They are the loyal customers. And the customers who have rated your product 7 and 8, they are passive. They are neither promoter or nor they are detractors. They are passive or neutral. While customers who have rated between 0 to 6, they are the detractors. These are the people who don't like your product and can even give negative feedback about it. To calculate NPS score, you subtract the percentage of detractors from the percentage of promoters. In calculation of NPS score, you do not take into account of percentage of passive customers. Basically, when you launch your product and services in the market, you start by a net promoter score with being 0. So NPS score of around 50 is actually good indicator that you have reached the product market fit, in which like 75% people are the promoters and 25% people are the detractors. So you can have such metrics and keep track of them and keep optimizing it to reach the product market fit.